Everyone loves pizza, and everyone loves money, and Domino's Pizza combines these two wonderful things. Similarly, my channel combines stocks and profits, so don't forget to subscribe. Since going public in 2004 with over 7,700 stores, Domino's is now considered the largest pizza chain in the world. Let's move on to the company's financial indicators. It can be seen that the company's revenue and net profits grow every year, as do its assets. Interestingly, the company's debts exceed its assets by several times, but the company continues to increase dividends and buy back shares from the market. I value the company at 1 out of 10. The company has a powerful brand in the pizza industry, but its main revenues come from franchising. Companies operating under Domino's pay a percentage of their total sales, around 6% for advertising and about 4% to the company. While more than 6,500 Domino's stores operate in the U.S., which is slightly less than 30% of the total number of stores, 61% of the company's revenue comes from importing products for these networks manufactured by Domino's. Although the company has production facilities in Canada, approximately 90% of the revenue still comes from the U.S. However, it's worth noting that the company has a monopoly on supplies for its franchises solely due to the most favorable terms. Specifically, the company promises to return 50% of net profits on the purchase of such goods from Domino's for its clients, meaning the net profitability of this segment is low, but it gives competitive advantages to their stores, leading to rapid growth of new stores in the U.S. Pizza is a popular product, and competition comes not only from large companies but also from small businesses. If you don't have a competitive advantage like purchasing at advantageous prices abroad, then to ensure the survival of franchises, you must take less, which is what the company does. Taking into account that such a product should be inexpensive in every country, considering the economic situation of each country and its currency and labor, it becomes clear that although the company owns more than 13,000 international stores, they bring minimal income to the company. Today, you can buy a share of the company for about $500, and its market capitalization is nearly $18 billion. Although I like the business itself, I believe it is overvalued. I would buy shares of this company for no more than $150 each, which is less than 3 times what you can see today. The point is that the company has insignificant assets and a large debt, nearly $6 billion. In other words, if I buy the company today for $18 billion, I will have another $6 billion in debt, and the total value will be $24 billion. If I take into account that the average interest rate on such debt is 5% per annum, it means that I need to pay only $300 million a year in interest payments when the company itself earns just over $520 million. And if we multiply the net profit in this situation, then by buying the company today, in about 110 years, I can double my investment. Due to the fact that the company increases dividends and more than a third of the company's net profits go towards it, as well as buying back shares from the market, the company has not only driven itself into debt but also destroyed the future, because if the company earns $520 million, pays out $170 million in dividends, and $300 million in debt repayment, then the company has less than $50 million for development. Think about whether you really want to buy such a business. I believe that the price of this stock should be 3 times cheaper. Even if my analysis is incorrect, I in no way want to own this company.